Welcome to Daxue Talks, a show powered by Daxue Consulting, a China-based strategic market research company founded in 2010.
Hi, I'm Jess. I'm an audit manager from Dezan Shira and Associates. We are a professional service firm providing all kinds of market entry, accounting, tax, legal, and other advisory services for international investors who would like to conduct business in Asia.
What are the major changes in CAS21? And what is the rationale behind it?
Well, the revised Chinese accounting standards on leases has fundamentally altered the accounting for operating lease. We used to do off-balance sheet treatment for operating lease, but now it has changed to on-balance sheet treatment. Well, the rationale behind this change, according to the standard setters of IFRS and US GAAP, is that the on-balance sheet treatment brings a more faithful representation of lessee's assets and liabilities. After all, when you enter into a lease contract, you acquired the right to use the asset for a substantial period of time. Perhaps it's not to acquire the asset over its entire useful life, but at least you have the right to use it for a couple of years. And also, together with some standard disclosures, the new lease accounting will provide greater transparency as to a company's financial leverage and the company's capital employed. So I think the question is not why we suddenly changed to on-balance sheet treatment, but why we would allow off-balance sheet treatment in the first place. Well, there are some drawbacks about the old lease accounting treatment about operating lease. For example, in US GAAP, there is a bright line test which are used to differentiate operating lease and capital lease. And this test can be subject to manipulation where you would find economically similar transactions. Sometimes you would receive dramatically different accounting treatment, perhaps due to some deliberate structuring of the underlying lease arrangements. In other words, there are long-standing criticism of operating lease that lessees enter into these arrangements simply to achieve off-book reporting. So the purpose could be to minimize costs. For example, leasing is often an attractive option for firms in financial distress, or it could be to achieve certain financial reporting objectives, or it could be to achieve off-balance sheet financing to avoid some rather stringent debt covenant provisions. So there are drawbacks of the off-balance sheet treatments for operating lease, but it does not mean that there are no disagreements. For example, with regard to the off-balance sheet treatment, some would argue that users of the financial statements can capitalize these arrangements themselves based on the future minimum lease payments for operating lease. So I guess this is what the financial assets and institutional investors have been doing when they analyzing the financial statements of a company. So the argument is that the company doesn't have to capitalize these assets and liabilities. Instead, the experienced users of financial statements can do it themselves. I guess this is not a very strong argument, because if capitalizing operating lease can better reflect the financial leverage or the credit risk of a company, then why not adopt the on-balance sheet treatment in the first place, which is exactly what the new lease accounting is doing. Or alternatively, one would argue that firms use lease as a means of efficient contracting. It is not simply to achieve off-book treatment. I think that a empirical question whether operating lease actually replace conventional debt in real life. Anyway, the rationale behind the change in lease accounting is that these changes bring a more faithful representation of the financial position of a company.
Any questions? We will find an expert to answer them. Drop your questions in the comments or send us an email, dx@daxueconsulting.com.